It's a light week in terms of economic data, with the most important releases being the business surveys from the major economies. But the true highlight will be the Fed's annual economic symposium. With U.S. yields on the verge of a breakout, Chairman Powell's signals about the path of interest rates will be absolutely crucial for the dollar. Once per year, Federal Open Market Committee officials gather at their summer retreat in Jackson Hole, Wyoming for a symposium to exchange views on monetary policy and economic trends. Although this is mostly an academic event, it has been used by Fed leaders over the years to signal major strategy shifts. Last year, Chairman Powell used this venue to declare that his Fed will continue raising interest rates with urgency to fight rampant inflation. He was trying to send the message that the tightening cycle was just beginning. What followed was a powerful rally in U.S. yields, which turbocharged the dollar and slammed stocks. The landscape is very different today. Inflation has moderated, although much of this improvement is because of declines in energy prices. Core inflation is still burning hot, and since the labor market remains extremely tight, there are concerns inflation might not return to its 2% target anytime soon. Adding fuel to such concerns is the recent streak of economic data. The Atlanta Fed GDP tracker currently estimates growth for this quarter at an annualized 5.8%, thanks to a resilient consumer and a booming housing market. With home prices hitting new record highs in much of the country, the cooldown in rents that the Fed has long anticipated might prove elusive. All this goes to say that while there has been progress on the inflation front, it is probably too early for the Fed chief to take a victory lap and declare mission accomplished. Most likely, his message will be flexible, keeping the door open for maintaining rates at current levels and for raising them again if inflation proves persistent. Now in the markets, Powell's comments could have a disproportionate impact given that U.S. yields are trading near their highest levels for this cycle. Jackson Hole can be the catalyst for a break higher or a rejection, driving the U.S. dollar accordingly. Overall, the fundamental outlook for the dollar seems bright amid a U.S. economy that is superior to Europe and China from a growth perspective.
In the Eurozone, the spotlight will fall on the preliminary PMI business surveys for August, out on Wednesday. Forecasts suggest the slump in manufacturing continues to deepen and has started to infect the much larger services sector, putting the brakes on the economy. The euro has shrugged off dire economic news for some months now, and has instead focused on the European Central Bank's rate increases that have narrowed rate differentials in its favor. That said, the ECB can only ignore the weaker growth profile for so long. If the data pulse continues to slow, the central bank might pause its tightening cycle in September, giving the euro a rude awakening.